Well, we had a press conference yesterday for the June 14th FOMC meeting. We have the summary of economic projections, and I have a recap of the press conference with the Q&A. So let's look at what we have here and what's different from the last time. This is pretty bold. For 2023, the March projection for GDP was 0.4. They've increased it all the way to 1%. Higher growth. Look at unemployment. They thought they could get it to 4.5, but if you're going to have this kind of growth, they think only 4.1. So they're forecasting lower unemployment, higher growth. Look at PCE, and it's the core that we care about, right? It was 3.6, now 3.9. We're going to get higher growth. Unemployment's not going to go up as much as we thought, so the core is going to stay sticky for a while. More resilient economy, therefore higher rates. The March projection for the terminal rate 5.1 is now 5.6. Next year, 30 basis points higher end of 2024 instead of 4.3, 4.6, and for 2025 instead of 3.1, 3.4. Their longer run is still at 2.5. So you can consider that the nominal neutral rate, R star, but in a nominal sense, 2.5. Look at for 2023, this is the full range, 5.1 to 6.1, and their March projection was 5.1. In other words, nobody is seeing any rate cuts from any of the participants whatsoever. The current rate is the floor. And if we look at Fed funds futures for December, the implied rate is 5.22%. So the Fed funds futures curve has now priced out any rate cuts this year. We've been saying for some time that if you saw the Fed funds futures curve that looked like this, I was saying it's going to have to flatten out over time because none of the participants see a rate cut. So it is going to have to come down, and it has come down. So Sunday's market outlook will be interesting to see where it ends during the week. That was the reaction off the Fed for the December futures. Are we going to stay there, or is the market slowly going to convince itself that no, there's going to be rate cuts. We don't believe the Fed. Everything's going to be fine. Inflation's going away. They're saying we have a higher view for inflation, so we have a higher view for rates. Now, this seems rational to me. Tuesday was irrational. CPI came out, and nobody, at least on Bloomberg and even CNBC, the headlines coming out, inflation going away, inflation the lowest since 2021, and everyone was focusing on just headline. And it's like, no, you got to look at the core. The core is unchanged at 5.3. It's 0.4 each month now for like the last 4 or 5 months. The housing component did inch up a little bit because we were watching the Zillow rent index, housing index, and they were going up. And they are rebounding. Rents are rebounding. Housing prices are rebounding. In Canada, they're really rebounding from all the way from the beginning of the year. So the focus on core is the right thing. But Tuesday, the market just didn't want to look at core and just wanted to look at headline. Even though energy is what led things down, it's like, there we go. There is proof. No, it's core. And I was frustrated all day long every time I saw a headline come out. Lowest inflation since this, lowest inflation since that, annualized inflation at 2.1%. I'm thinking, what are you guys looking at? The willingness to look past what the Fed is telling you it looks at. Core. And it looks at core PCE, not CPI, and core CPI unchanged. Okay, let's get to the press conference. We needed the summary of economic projections because I think 3 or 4 questions referred to the SEP. Opening remarks. First thing he said after good afternoon, we are squarely focused on our dual mandate. We're strongly committed to bringing inflation down to our 2% goal. Without price stability, the economy works for nobody. Will not achieve the conditions for sustainable, strong labor market. The full effect of tightening have yet to be felt. And I put in red, he repeated it twice here. Nearly all participants view as likely that further rate increases will be appropriate this year. Hence the SEP showing the median estimate to be 5.6. The top estimate 6.1, the range 5.1 to 6.1. No cuts, just either you're going to stay where you are or increases for this year. Notes that real GDP growth for the next 2 years will be below trend. Labor market remains very tight. Some signs of improvement, but labor demand is greater than labor supply. And there is some discussion later on about why the focus on the labor market. And there is some reference made to a paper from the San Francisco Fed showing that wage inflation is not the cause of inflation. So he gets asked that question later on of why are you so focused on this when your own Federal Reserve, one of your own Federal Reserve branches, are saying it doesn't matter. Inflation moderated somewhat since mid last year. Nonetheless, inflation pressures continue to run high. The process back to 2% has a long way to go. Economy is facing headwinds from tighter credit conditions, and then he repeated nearly all participants are saying there's more coming. We remain committed to bring inflation back down to 2%. Will require a period of below trend growth and some softening in labor market conditions. Okay, I'll cut it off here and we'll cut it off here. Financial Times. Why would waiting not be counterproductive while monthly core inflation remains elevated? Housing appears to be recovering and financial conditions are easing. And this is what we saw on Tuesday. 5.3% year over year, unchanged. 0.4 month over month, unchanged for a number of months running. There is no progress in core CPI at all. Housing is rebounding. In Canada, housing prices are up considerably. In the US, if you look at the Case-Shiller price index, it was up on the last reading. It showed a positive read. And the Zillow Housing Price Index is showing increases as well. Yes, it is recovering. Housing stocks on fire. Lennar reported last night delivered way more houses than the estimate thought. So the market is coming back for it. And when you get that market coming back, even at these high rates, the market is coming back for it. So high rates are not enough to kill that. But there you go. And financial conditions, well, I don't have to tell you about the equity markets. Have you seen them lately? His answer, which I thought was pretty good, and he uses it again with the Wall Street Journal. He said, think about three things: speed, levels, and the time elevated. He said, let's talk about speed. We've moved quickly and then we moderated. And he's saying, for speed, we're done. We're done with the speed. Now we still have to think about what level do we want to get to and how long are we going to keep it there. We're still debating the level. And he says the pause is only about this meeting. And it's he calls it a skip later on. Then he catches himself and he says, I shouldn't have called it a skip. Which to me seemed like the wrong thing to say. You know, if you think that there are more rates ahead, this is a skip. I don't know why you don't want to call it a skip. And then for time elevated, he really didn't answer that, but he's just saying, look, you got to think about what we're doing in these three terms. We've got the speed out of the way. We just don't know what level we're going to get there, but we can take a more measured approach to get there. And as far as time elevated, he did make some mention later on in the press conference that you're looking at about 2 years. 2 years before we start to lower rates. 2 years. Then the follow-on question is, what are you going to do in July? Are you going to raise rates in July? Was this a skip? No decision, but it will be a live meeting. Reuters refers to the SEP. Dot plot up. You've brought real GDP up since the last SEP. Unemployment down since the last SEP. Core PCE up. Where is disinflation going to come from? If you're raising rates, if you're raising your forecast, if unemployment is not going to come down, if you say core PCE will be elevated and higher than you thought, where are you going to get disinflation? Inflation data came in consistent, but on the high side. 5.6% is consistent with the SEP. So if we have this forecast for real GDP that we saw, the forecast for unemployment, and the forecast for core PCE says if the economy unfolds as predicted, 5.6% is consistent with all of that other stuff. Disinflation will be gradual. Goods, supply must come back. He said that it's not fully back yet. Supply must come back. Housing, progress here. It's a matter of time, and he expects it to be into next year before that takes care of itself. Services X housing, only the earliest signs here. The largest driver equals wages. He's going to be questioned on this later on. His answer is unsatisfying. So I think there's a contradiction within the FOMC as to the role of wages, but he seems to want to keep the market squarely focused on wages, but he danced around that very carefully because it is political. He can't say he wants wage increases to be lower. He can't say that politically, but he somehow wants to keep the markets focused on wage inflation. But, well, we'll see when we get to it. We need loosening in the job market. I just want to point out now that this is what he's saying here. The largest driver is wages. Keep that in mind. He said that, and then we'll see what he says later on. Conditions we need to see are coming into place, but the process is going to take some time. I don't think he should have said that. I think he should have said, he should have left it at this, that there's progress, but it's going to take some time. Conditions we need to see are coming into place. This really, when he said this is when the green bars started climbing the side of the chart, and the sell-off, we were down like I think 25 points on S&P, and within a matter of, well before the press conference was over, the S&P turned green. And I bring it to this, it was right around this answer. I had the chart open on the monitor beside the press conference, and I'm watching the two together to see exactly what the market's responding to, and it started going up. And I think, well, what did he really say? So reviewing it, I think, well, maybe that's what it was. Wall Street Journal. What's the value of pausing and signaling future rate hikes versus just hiking? You know, so if you pencil in 5.6 for the end of the year, why not just do it now? Why wait? Why not just raise now? And here he made the distinction again between speed and level. Speed, which is done, is different than levels, which is not done. We're not racing like we did before, but we're not done. We're not at the level we want to be at, but we don't have to use the same speed we used before. In answering the Wall Street Journal's question, he did refer to the meeting as a skip, and then he looked down, he verbally corrected himself. He says, I shouldn't have called it a skip. I shouldn't have said that. And he thought out loud. And of course, that led to a follow-up question. Well, you won't have the ECI, you won't have the SLOOS by the July meeting, only the June CPI and jobs data. What incremental information is needed to make this meeting a skip versus a pause? You don't want to call it a skip? Well, what information would you need to see such that this either was a skip or a pause? And he just said, look, the next data points get added to the past data. We look at a lot of things. You know, you only pointed out two. We look at a lot of things. New York Times, since the last meeting, what has happened to justify real GDP up, core PCE up, unemployment down in the SEP? And is 5.6 the end or higher? I didn't think he was going to answer that. Part one, following the data, labor market has surprised all of us. Part two, terminal rate for 2023 could end up being higher or lower. I didn't think he was going to answer anything on any particular level, because he has already said earlier in the conference that speed is done. We just don't know what level it is. It's an ongoing debate. And, you had a couple follow-on questions later in the press conference asking about levels, and I didn't think he was going to answer them. CNBC, end of May, you said risks are in balance. Is that still the case? And what is sufficiently restrictive for the federal funds rate? Answer, balance of risks have come closer over time, but we're not there yet with inflation. And sufficiently restrictive, no number, which I think this is a pretty good answer overall. There's no number, he just stated what we need to see. So he's saying sufficiently restrictive. I'm just going to not paraphrase, but use my own words to translate. What he's saying is sufficiently restrictive is not a number. It's a state, and we will know that state when we're in that state. And when we're in that state, whatever the rate is sufficiently restrictive. We just don't see that state yet. So 5.1, or where we are, 5 to 5.25 is not sufficiently restrictive, or it is, and the lags just haven't shown up yet. Now I find, let's just pause right here for a second. I have said this in the market outlooks before that if we think that we're going to get a soft landing and economic activity is going to expand from here, and the SCP since March is saying, yeah, GDP will be higher, unemployment will be lower, PCE will be higher. If we think that that's going to happen, and we're at 5 to 5.25, then the neutral rate is a lot higher than what everybody thinks. You have to accept that if the economy can go, we're going to expand from here on in, and unemployment is going to remain at these 50-year lows, and up we go, and everything's going to be great, and corporate profits are going to be robust and grow, then the neutral rate is here or higher. The neutral rate's going to be here or higher. And just before the press conference on Bloomberg, one of the on-air personalities was retelling a message or some information that Neil Dutta had put out, specifically saying that he believes the neutral rate is higher than where everybody else thinks it is. And I agree. The neutral rate, if the economy is this resilient to this point, the neutral rate is higher. So the idea that we're going to go back to 2020, 2021 levels on the interest rate, which I think the market is anchored there, saying we've departed from our home, which is the zero line, but we're going to go home soon. The Fed's going to start cutting rates. Why? If corporate profits are 11.5%, 12% of GDP, if unemployment is at a 50-year low, if you're forecasting higher GDP growth going forward, why are you cutting rates? The SEP is important here. Real GDP their forecast went from 0.4 to 1%. They have two mandates, and the first sentence was, we are squarely focused on our dual mandate. One of them is full employment, and they're forecasting an increase in growth and lower unemployment. They're not even looking at that. And they also took core PCE higher, which led them to the 5.1 terminal rate going to 5.6. So with all of that going on, they're saying, look, the labor market has surprised all of us. We're taking our forecasts for full employment higher than under the weight of 500 basis points. This is where we are, that we're upgrading our growth forecasts. I want you to think about that statement. We've raised interest rates 500 basis points and we're upgrading our growth forecast. That means no matter how you cut that, you're going to have to conclude that the neutral rate is higher. The cost of capital must go higher, and that hasn't been factored in yet by the equity market. Washington Post, about the lags, are there things you would expect to kick in to inform your decision? They're long and variable. Financial conditions tighten well in advance of Fed action. So he's saying if you look at the yield curve, and you go back to last year, before every meeting, the yield curve had already increased. And I was pointing that out last year as well, saying, look, the Fed can go 50. The 2 years already moved 50. All he would be doing is filling in the hole that the market already created. In other words, rates are already up 50 basis points. You wouldn't be changing anything by increasing. So he is right on that. He says it happens much faster today than it did when things were just reported in newspapers. The effect on broader demand and asset values just take longer. I don't know why he included asset values in here if he's saying financial conditions up here, because it is transmitted through asset values. But anyways, okay, the broader demand and asset values just takes longer. No agreement on how long that is. And I think he put that in because given how the equity market has been responding, since the October lows, I mean, we're in a new confirmed bull market, and he is holding a press conference where he's increased, the SEP has increased the core inflation forecast, and they've increased the terminal rate. I think he might have in his head been thinking about current asset values. It just takes time for current asset values to get the message, so that he might be sort of inadvertently smuggling in a bear thesis on the market with that statement. Follow-on question from Washington Post about credit tightening. Any comments on what you see there? Answer: too early to assess the full extent, but if tightening credit happens faster than we expect, that will affect future rate decisions. Associated Press: you say trends are in place for inflation to drop. Why signal additional rate hikes then? The forecast for lower inflation have consistently been wrong. Look at core, just not seeing any progress. Have to get inflation back to 2%, and we just don't see that yet. Follow-on question, last press conference, you mentioned you did not see wages driving inflation. That's interesting, right? Last press conference, you said you didn't see wages driving inflation. Now remember earlier in the answers, he did say that the biggest driver was wages. Research from San Francisco Fed, this came out in January, is saying the same thing, that it's not wages. Why say anything about the labor market now? And this is a really unsatisfying answer. I expected him to defend it a lot better. I'm not going to comment on any specific paper, okay? Many analysts believe wage inflation going down is needed to get core inflation going down. Whoa, you got a whole Federal Reserve System. You didn't say your own people. Many analysts. Who are these many analysts? It seemed that he was caught in a contradiction and he didn't know what to say, which leads me to think, is there a deeper contradiction within the Fed? Do you have some people lining up on one side saying wage inflation needs to come down, it's the cause, and there's a bunch of people on the other side saying, well, but no, it's not. Now, we have to keep in mind that most of the research saying that wage inflation is not the cause of inflation tends to be from more progressive-leaning researchers or progressive-leaning institutes. And San Francisco Fed is a very left-leaning progressive Fed. And there was a few other papers that talked about this. And there are two in particular that were put out pointing to corporate greed as being the cause of inflation. Not the workers, not labor, it's corporate greed. Well, now you got to say, okay, hang on a second. I see a lot of ideology coming into the research here, and you're researching from an ideological perspective out of the gate. So is Powell doing one of these dances where you have to say, well, I can't really shit all over the progressives and tell them, look, I don't buy into this ideology, but at the same time, he can't probably abandon what he believes in. So, is there a Republican-Democrat divide going on inside the Fed here? I find that interesting. He didn't want to say his own people. Many analysts believe it. Okay, there's a lot of people who believe it. And I'm not going to comment on any specific paper. And the only paper that was mentioned was San Francisco Fed within the Federal Reserve System, and he wouldn't want to talk about it. So I got a feeling that there is a little bit of divide going on inside the Fed. Bloomberg, you don't like to surprise the markets. You said it'd be a while to bring inflation down. How should we view the Fed's reaction function then? What would we see? The main focus is on getting policy right. You will have to wait and see and listen to the Fed speakers. And he said again, July will be a live meeting. Follow-on question from Michael McKee at Bloomberg. Will inflation continue to come down based on the lags? And the answer, he referred to core PCE forecast in the SEP. Didn't want to say no, just said I would refer you to the SEP where they are forecasting higher. So will inflation continue to come down based on lags? Being that he said look at the SEP and the SEP is higher, his answer is no. No, it will not. Politico, the balance sheet. Are we approaching reserve scarcity? Will Treasury issuance affect that? Because remember, they are conducting monetary policy in what is called an ample reserves regime. And the curve kind of looks like this to get to ample reserves, right? so that they can conduct monetary policy without any sensitivity. Once you start to get to this part of the curve, you start to get sensitivity on the reserves, and monetary policy isn't going to be as effective. Are we approaching reserve scarcity? Will Treasury issuance affect that? Are you considering lowering the RRP rate to take pressure off banks? Answer for Treasury, we're watching. Likely involve a reduction in reserves and in the RRP facility, but both are starting at high levels, so no scarcity is expected. As far as lowering the RRP rate, it does not appear to be pulling deposits out of the banks, so no, because that is used a lot by money market funds that can't put their money in any really short-term T-bills. They stick it in the reverse repo because they're getting a great rate. And the thinking is, well, that's drawing deposits out of banks into money market funds, and they're using the repo. So I don't know that a depositor is saying, oh, those repo rates are really great, I need to access them, let me put my money in a money market mutual fund. I don't even think they know that that's what happens, but he's saying, no. Nothing to see in reserves, nothing. We're not doing anything with the reverse repo rate. It's not really affecting anything, so no. Another question from Bloomberg, sufficient cooling in the housing market yet? Because he, in his opening remarks, he did mention that interest rate sensitive sectors are showing the effects and that housing is down. Housing is down year over year, but it is bouncing off a bottom here. And he says, we see housing putting in a bottom and moving up, but not quickly. So he did give a nod to the fact that, yeah, we see housing recovering, but not quickly, and it'll be slow. Labor market surprised all of us, but don't worry, we got this one. The rebound will be slow. If the labor market surprised, the resilience in the labor market surprised you, I would not discount that the rebound in housing prices will also surprise you as well. That if you can manage your monthly payment, you don't care about the interest rate or the price. All you care about is that monthly payment. And keep in mind, wages are going up at what, 5-6%? 5 to 6%. So each year, if you say, well, our monthly payment is going to be $4,200 a month, but next year I'll have 5 or 6% more on my pay. The next year I'll have 5 or 6% more. The next year 5 or 6% more. So the affordability of this house will only improve year after year. And if I don't get these raises, I know I can switch and get 6 to 7%. So being that I have a growing annuity in my income and a level payment system, I can afford it. Yeah, it'll be tough for this year and maybe next year, but after that, things are going to be great. Well, once you get into these houses, you basically need those wage increases, right? We see housing putting in a bottom and moving up, but not quickly. Well, let's watch. This gives us something interesting to watch now. Is the housing price index, because there is this belief that it's fading away, the base effects will go, and that's going to run itself out. So the rent index and the housing index are going to be data points that we definitely want to watch. Fox Business, and this was just a dumb question and a waste of time. Not that it was a dumb question, but it's a dumb question to ask a public figure. Like the head of the Fed. We're on an unsustainable fiscal path. At what point do you say something about fiscal responsibility? The way he looked, at the guy was like, fuck off. But he just said, that's not my job. Period. He wasn't even going to entertain it with any kind of explanation or anything. He just looked at him with this look like, seriously, you dumb fuck? That's your question? Will the Fed finance government spending? No, under no circumstances. Next question came from, I don't know, they didn't introduce themselves, they just started speaking. The SEP, is the committee more confident about the prospects of a soft landing? And his answer, we continue to think there's a path with a labor market that gradually cools. Committee completely unified on the goal of 2%. We will do whatever it takes. We cannot allow inflation to get entrenched in the U.S. economy. He, several times in this press conference, kept bringing it back to inflation. He didn't bring it back to full employment. He kept bringing it back to inflation. Whenever he talked about employment, we got to get slack into the labor market. We got to have some easing in the labor market. Wage inflation is too high. Whenever he brings it back to inflation, too high, too high. We should be very, very clear what they're looking at, which is core PCE, period. They're not concerned about a small little rise in initial claims. They're not concerned if job creation drops to 100 or 150. They're not concerned about that. It's inflation, period, and back to 2%, not 3%, not 3.5, not on its way through 3%, but back to 2%. And then he said, and I put it in red, we are a couple years out for any rate cuts. No rate cuts this year. Inflation has not really moved down, so we have to keep at it. And then AFP News, I think this was just a wasted question, but I understand that it had to be asked from AFP. Are you worried about the increase in black unemployment? And what answer are you going to get from a public figure about something like that? What you expected him to say, no, we're not worried about that. His answer was a very liberal answer. We are concerned about inclusion, this, that, but the interest rate is what the interest rate is. It's not a precise tool, but he danced very carefully around that whole answer, making sure not to say anything at all. But when I heard the question, I thought, well, come on. I mean, here you have one question to ask this guy, and you're asking a question that I'm pretty sure you already know what his answer is going to be. It's a wasted question. I'm not saying it's a frivolous question. I'm not saying it's a question that we shouldn't ask or look at, but don't ask a public figure in a press conference what he thinks about that. You're going to get a very cleansed answer that's not going to give you anything to write about. Then followed up with rent. Waller says the uptick may work against inflation. And his answer was, well, we're going to need to see rent growth stay low. So we are going to, again, as I said earlier, look at, on the weekly outlooks, include a rent, look at rent and housing. But we only get that data infrequently, so it's not high-speed data. And then another question on wages: how far will wages need to come down? And the question wasn't asked that way. It was how far will wages need to fall? And his answer was, wages won't fall. Wages will continue to go up. We're not looking for them to fall. We're just looking them to go up at a pace that is consistent with 2% inflation. Because at first he said we needed them to go up slower. Then he said, well, we're not against wages going up. We'd like wages to go up, strongly, but in a way that's consistent with 2% inflation. So we had to do a little bit of dancing here as well, because to say that we don't want people making as much money, even though that is really what they need, is not politically acceptable. The Democrats in Congress would have a field day with him if he ever said that. So he's got to acknowledge the progressive side of America, which is why he probably didn't comment on the Fed paper, on the San Francisco Fed paper, which is probably why he deflected on the question of wage inflation, saying many analysts believe it, and saying, well, we have to include them, right? You gotta bring them in. He's not going to talk about any kind of specific racial issues whatsoever, and he had to dance around this topic as well. Next question came from MarketWatch, and there was this uncomfortable pause when he said his name. Hi, blah 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 from MarketWatch. I guess he was waiting for Powell to say hi. How you doing? But that never happened. Powell just looked at him like, yeah. Oh, okay, the strikes. So we're seeing strikes in Hollywood. UAW talking about strikes. Labor's got a lot of power right now. Does this matter to you? Not really. Bank rate. I thought some of this was interesting. Level of systemic risk. Commercial real estate. Non-bank financials. Could you be elevating those risks with higher rates for longer? For CRE, we are watching there is a substantial amount in the banking system. System could and will take losses. Some will be in trouble. Now, he didn't quite use those words. I'm paraphrasing. He says, to the extent that commercial real estate is dispersed across banks, the system itself will be okay, but yeah, there'll be losses. To the extent that some banks have concentrated exposure, yeah, they're going to be in trouble. He's basically saying it. He didn't say that he's unconcerned about CRE. He's saying, yeah, some banks are going to be in trouble. Yeah, look at that. Non-banks, non-bank financials. It's not our jurisdiction. And systemic risk, we're watching. And that's your press conference.